But truthfully, the system died in 2008, and that's when I began prepping. Most people would not understand what this headline means. Dollar poised for worst first 100 days of presidency since Nixon. Or they wouldn't even know why it matters to them. But here in the U.S., we work for and spend dollars. And frankly, does anything seem to be different for your personal experience? So nothing to worry about here because everything is just hunky-dory. Of course, that's also what Nixon said when he took us off the gold standard. But what if I showed you that what this headline is really saying is that the global monetary system is changing, resetting, if you will, into a completely new system? Look at this. This is exactly what was happening in the 1960s run on the dollar that concluded in August of 1971 when the then President Nixon reset the U.S. dollar and the world from gold's backing to debt backing, showing Nixon as a defender of the dollar in this Time magazine. Isn't that interesting? Now it's Nixon, it's the U.S. against the world. I mean, kind of sound a little familiar? But the U.S. dollar is represented as being made of, what is that? Gold. Isn't that interesting? And therefore, the perception is that the dollar is as good as gold, while those bad foreigners chip away and scheme against us. Can you see that Bitcoin, the Trojan horse of the digital currency, is also represented as gold? Interesting parallel, don't you think? And can you also see a parallel in how President Trump is viewed as a transformative president? And he's certainly lived up to this, right? Is it possible that is his job this go-round, to transform the debt-based fiat money into programmable fiat money? And what is fiat money anyway? Do people even know that? Fiat money is government legalized currency, like a whole bunch of this crap, right? That doesn't even exist anymore because it's used in only one sector of the global economy. So if demand goes away, the truth is revealed in a hyperinflationary depression. At first, fiat financial assets soar in nominal terms, right, in number terms, but then those same intangible assets are reset basically to zero in an overnight revaluation. What you're seeing here is the new Zimbabwe currency, the ZIG gold, Zimbabwe gold. It's a joke. But anyway, you see that overnight reset of 44% just last October? Look, you guys, if you've been watching me for a while, you know that I've been tracking Zimbabwe since 2006. And you can watch other videos I've done on this. But it's a great chart to show you spot gold's behavior in an overnight reset. Why? Because physical gold and silver is all intrinsic value, where this stuff is no intrinsic value because it's only used in one sector of the economy. Gold and silver is used in every single sector of the global economy. So can you see why having your sound money strategy in place when this overnight reset happens? And for those who think that overnight reset is impossible, they have hopium. Well, let me show you why there frankly is absolutely no choice. There's just no choice. Because like I said earlier, in our current system, money is created from debt. And look at this level of debt. This is that the public holds, Fed debt that the public holds. Well, the latest Fed data shows $36.2 trillion in debt that's held by the public. And by the way, a chunk of that from our government borrowing excess funds from the Social Security system, but we'll talk about that more on another day. But then let's add on the 8.5 trillion owned by foreign investors that are now, quite frankly, leaving us, turning their backs on us. And what about the two biggest buyers of treasuries, Japan and China? Can you see that they have actually begun to move out of treasuries back in, what year is that? Oh, 2013. And remember that date because it's going to come up again shortly. But what they're doing is reversing their buying spree. You see that downward arrow? They are now in an obvious way. So it's more than China and Japan. They're selling off their holdings. That is not a good thing when we here in the U.S. need to create more and more debts and therefore more and more dollars. I mean, frankly, this is how we do it. We create those debts and that creates these dollars. So we need to do that to fund the trillions in planned deficit spending, which, can you see this? We are already above $2 trillion. But that deficit spending, let me define that for you. Because every time you use a credit card and you don't have the money to pay for the goods right now, that's what you're doing. You're deficit spending. So deficit spending is creating money from debt that well, in the government's case anyway, they know that it's never going to get repaid. Why? Because if they repaid it, then all of those dollars, if we could do a reverse, that would be great. But all of those dollars would be sucked out of the system. And this whole system is based on more dollars, so inflating that. But can you see that there really is no choice if you're just doing deficit spending to create money? You can't suck it back out of the system. There's no choice. And the U.S. has gotten away with it all these years because they were able to create an artificial market for dollars, the petrodollar, as the world reserve currency. Further, that status supported the use of treasuries as support for the global markets. And while we are just now hearing about the world recognizing that treasuries are not as safe as what was one thought. So how have the central banks and governments been able to hide that massive buildup of debt and our two biggest debt buyers pulling back? Well, here you go. The biggest tool that central bankers have are interest rates. Because as you grow more debt, if the interest rates are lower, guess what? You can accommodate more debt for the same amount of payment. And remember, right? This is how debt works. This is interest rates. This is the market value of the bond, right? It's issued at par, so it's issued at that $1,000. But then what do? Interest rates go down, as we see on this graph from the Federal Reserve, and the principal value of the bonds go up, hiding the fact that they were being sold off. Now we broke a long-term 42-year cycle, a trend of declining interest rates. And then when interest rates go up, what happens? The market value, the principal market value of the bond goes down, and it exposes a lot of the flaws that we're seeing. Because those lower interest rates, again, just as a reminder, they enable the borrower to carry more debt for the same amount of payment. And that can cover up the growing threat of unpayable debts and compounding interest rates. But quite honestly, after the 42 years of declining interest rates and debt expansion, well, shockingly, inflation reared its ugly head at a fast and furious pace that the public noticed, because it impacted the public at a very highly noticeable level, and that forced the Fed to raise interest rates and break a 42-year trend. Now, the reason why I'm harping on this is because that is a pattern shift. And you don't even have to understand what those pattern shifts mean. All you have to know is that when there is a change in a typical pattern, it means something. And because interest rates are a key tool, or have been a key tool of the central banks in regulating the rate and speed of inflation, and therefore that level of debt that can be carried, this is critical for you to understand. So can you see how all of these warnings, they've been flashing for many, many years. And people will say, well, Lynette, you talk about the same thing over and over again because it's unfolding. When do you want to know? 1 second before, when it is too late to get prepared? And by the way, can you tell me the exact moment that this is going to become apparent to the public? Because I couldn't tell you that, and I'm very much a technician. The problem is that dollars are created from Treasury debt, but Treasuries, once considered very safe, are becoming more and more volatile, and that means the true risk of them is also becoming more visible. What you're looking at here is a chart that doesn't even exist anymore. They started looking at it in 2003. It is the volatility index on the 10-year Treasury. So it shows you the trading range of it. And you can see, I'm going to show you this in more depth, because what was once considered safe are becoming more and more volatile, and it confirms that the global confidence in U.S. debt is fading, and the illusion of a secure foundation is absolutely cracking. And let me show you what that means, because it's not the central banks that are buying the treasuries anymore. And while we have just now heard about this, well, quite honestly, we've known about it for years, right? It is trading like a risky asset since 2013, as the Treasury markets were actually handed over to the trading markets. And, I don't know. Is it a coincidence that they discontinued this particular graph? Maybe so. If you're listening to this, this is an extremely important chart to understand, because it shows you the evolution of the 10-year Treasury from that bedrock foundation to a risky asset. And you can see in here, this is between 2003 and 2008. The foundation of the global financial markets looked like dashes. Can you see that? Well, what this represented is the price action of the treasuries, right? What do you want in a foundation? You want it bedrock. You want it absolutely stationary. You don't want it to move. So what you're looking at here between 2003 and 2008 is that bedrock. It makes sense to be the foundation of the world. But I've been saying since 2008, quite honestly, that that's when the system died. So look at this. Between 2008 and 2013, when the system died, 2008, what was once dashes? Solid, rock solid price action. It's not going to move. You're going to be able to know what the price is. Well, now we started going up and down and trading, right? It started to become a lot more volatile up until 2013. And look at how they shifted from that stable asset to that risky asset, where between 2008 and 2013, it was like this. And now, up until 2016, it was like this. Well, I don't know. I'm sure that stopping reporting this, well, heck, it's just coincidence. They certainly wouldn't try and hide anything from you. What do you think? And even if you are watching this, if you'd like to spend some time understanding this chart, please call your strategy specialist. They will walk you through at your pace to help you see it and help you understand it, because we here are all about truly educated choices and giving you the tools that puts your best interests first. What a concept. But truthfully, we are really all here to be of service. So let me show you what I'm talking about. Anyway, right? They want you to think that this just happened. In reality, it would be one of those hidden dangers that is invisible to most and therefore dangerous to the many. But we were warned. Look at this. If you understood this chart, if you'd been watching me and following me since then, this you would have known about, because I can't even pull this up again. Thank God I learned print screen, let me tell you. But this is dangerous. And the warning is here. And now the tariffs and the trade tensions are exposing all of those vulnerabilities in the dollar and particularly in the Treasury bond market that accelerates the move away from the U.S. debt as the global standard. But this is a huge problem, and it's that doom loop, right? Because as other governments and other central bankers move away from buying treasuries, that's less support for treasuries and therefore less support for the global markets. But with what's going on, because look at this. Can you see that if this were a chart of a heartbeat, so what looks like stability in 2003, look at it now. It looks like cardiac arrest. That's how far the price of treasuries were. That shows a very liquid market. But boy, going past that, I'm telling you, you can see it right there. And it's got to be way worse than that today. And they're just not showing it to us because what do we need to know? They took how much money they were printing away from us in 2006 too. No need to look behind the curtain. But truthfully, the system died in 2008, and that's when I began prepping. That's when I did the food, water, energy, security, the barterability, and the wealth preservation that I had been doing. But building community and building the mantra, making sure that you have a safe last stand, for me, that started in 2008 because 100%, I knew that the system died. And that's why local community is so important today, because you just don't have that same time luxury that I had since I was warned and believed the warning. But today, you need to make sure that you can create security in all of those mantra pieces. Again, I'm sorry to be redundant, but food, water, you can't live without either one of those. So food, water, energy, security, barterability, wealth preservation, community, and shelter. Please, my friends, please get it done, because this is all happening at the same time. Remember I said we'd talk about 2013 again? Do you think that it's a coincidence? And maybe it is. I don't know. I don't really believe in a lot of coincidences because I think a lot of things are just shown to us and we have to agree to view them. And I think this could be one of them. Because do you think that it's a coincidence that the markets got a whole lot more volatile once Japan and China started moving away from treasuries? I don't know. You tell me. Because when the market traders took over the bedrock foundation of the global financial system, well, I got to ask you, how safe do you feel? Can you tell me how much longer this system can withhold all of this pressure? Because it's happening faster and faster. This is all the warning that you should need if you do not have your sound money strategy in place. Get it done, get it executed. Because I'll tell you, I might miss trading opportunities, which is what people tell me all the time, but I don't really care because I am not a trader. I am a strategist, and I know what happens during currency life cycles issues, and I know how to read the technical language of the markets, and frankly, I would rather be 20 years, 10 years, 5 years, 5 months. I would rather be early than even 1 second too late. This was a warning of something nasty coming in the future. Well, I believed it. Do you? Why did they stop publishing this graph? Is there something that's being hidden even more? Because this is the heartbeat of the 10-year Treasury market. And I don't know. Looks like cardiac arrest to me. What do you think? Because if you have not yet established and executed that sound money strategy, just remember, typically by the time the general public sees the crisis, it's already too late to do anything. And now the world is beginning to obviously turn away from the U.S. dollar standard. And here in the U.S., we're going to have the greatest impact of that. So can you see why I say that we're at the end of this con game? Because any con game requires new money. That's what it is. And the world is saying, no, you're not going to get that new money from us. So where is that coming from? Right here, the Fed printing presses, that's the only place they can get it. When the world runs away from the dollar. And the world is beginning to realize the danger of the debt bubble that has popped when the interest rates spiked. Perils in the Treasury market have become more acute in the last several years, but they have always been there. U.S. bonds have never been risk-free. It is just perception management that makes you think that they are risk-free because the government can print the money that they need to repay you. But every single time they do that, the value of what's already out there goes down. Yep. And now the world is waking up. It seems like gone are the days when governments, institutions, and banks and hedge funds use treasuries as a safe haven. First, the market sees it, which is happening now. When that tariff tax becomes visible to the public, and we're hearing that businesses are starting to break that extra cost out as a line item. Gosh, Amazon was thinking about doing it. And what happened? Oh, no. That was an act of political war. Because they don't want you to know what's really happening. And when prices just go up through inflation and all of their choices, what do? You blame the company. You blame the business for raising the prices. You don't blame the Federal Reserve, the central banks that are the real cause of this, and the government spending that is the real cause of this devaluation that has been all in the design of the system since the very beginning. How about that final snowflake? Is this the final snowflake? We don't know which one it's going to be. In the waiting loss of confidence avalanche. Because the confidence numbers are abysmal and getting worse and worse and worse. Could this be the real reason behind spot gold's rise? Because gold is real money. And it will ultimately reflect the true weakness of all fiat currencies. Gold trades steady on profit booking after topping 3,500. You know, people look at that and they go, "Ooh, gold is 3,500. It's so expensive." Now, when you look at its true fundamental value, that's over 40,000. So to me, 3,500, chump change. And that pullback from that 3,500, just profit taken. That's all it is. Gold is real money, and it will always reflect the weakness of fiat currencies. It's not gold going up. It's the currencies going down. And remember, the current spot gold contracts rise supports that trust in central banks is ending. And if at some point President Trump does get a sympathetic central bank chief installed at the Fed and they don't completely take it over, either way, it would work the same way. Would that trigger the Fed losing credibility? But even at 3,500, 10,000, 30,000, a number that my friend Robert Kiyosaki just recently brought out. Well, or my number, go ahead and my number, 40,000. So as outrageous as those numbers might sound to you, have you ever thought that those predictions might just possibly be accurate? What would people have thought in 1913 when the price of gold was $20 an ounce, minted on the coin? Today, that 1907, so this is slabbed, it's even more than that. But that 1907, which is what that is, extra fine, very fine, just a raw gold coin, it's selling for somewhere around $3,900. They would have said, that's ridiculous. That's never going to happen. But frankly, today, every single asset has been turned into a trading product. And traders are just focused on picking up that profit. They don't care. The true fundamental value is not important to a trader, but it is very important to a strategist. So let them take some profit in terms of the dying dollar. What do you care? You and I want real, sound money that cannot be inflated away. So now you know what the headline, dollar poised for worst first 100 days of presidency since Nixon, really means. That the most important support for the global financial system is dying and must reset into a new system. Remember, what was once a gold-backed system was reset into a debt-backed system. And that system is now setting up the crisis to move the world into a programmable backing. But it's also a time of hope. When you put in place a plan, a sound money strategy that enables you and your family to sustain a reasonable living standard during hyperinflation through the use of a barterable gold and barterable silver portfolio. And don't forget the importance of local community to create security in those necessities of life: food, water, energy, security, wealth preservation, barterability, community, and shelter. These are all the things that will enable you and your family to secure those necessities and be able to say, no, I don't like what somebody's doing. I don't like what the government's doing. I don't like what the central bankers are doing. But there's also the opportunity to grow your wealth base in income-producing assets that can provide you lifetime income and be passed down or donated as you wish. I mean, the strategy is all based on what you are trying to accomplish. But right now, those assets still remain severely overvalued. Those income-producing assets, gold and silver, remain severely undervalued. That's going to flip-flop. And that's what creates that opportunity to grow that wealth base and generate income you can't outlive. And all you have to do is be in the right place at the right time with the right asset: sound money, gold, and silver. How would that make you feel? I mean, for those of you that have executed your strategy, how do you feel? Can you sleep well at night? Because I've shown you that as the new fiat money is portrayed as if it is as good as gold, but it's not. There is no substitution for sound money gold. None. They've tried it over so many years, thousands of years, and they've never found one. And how would it make you feel if you actually influenced the next monetary system? Because what can one person do? Nothing. But together, I'm getting chills. We can do everything. I know we can. So let's join the sound money movement and create a very quiet revolution just by converting your fiat money that's being inflated away into physical gold and silver that you hold in your possession. And until next we meet, please be safe out there. Bye-bye.